This market, if we're going into a bear market, it could be 2 to 3 years of a bear market. If this is going to happen, it's going to be ugly for quite some time because, unfortunately, stocks are too high priced, especially the big outfits. I'm not talking about small companies like SoFi, small company like Rocket Lab or GameStop. I'm not talking about stocks and companies worth less than 50 billion in market cap. I am talking about hundreds of billions of dollars of market cap stocks that are way overpriced. I mean, Tesla is still 132 times earnings right now at the 272. I mean, that's still overpriced. If we're going into a bear market, stocks like these are going to get a haircut. Looking at like Costco, as great as they're doing, they're trading at 54.5 times earnings. They're triple what they should be. This should be a $300 stock. In a bear market, this will drop by 50%. I'm not saying it's going to happen. I'm telling you, that is where it has to go if we're going into a bear market. I've been there. We've done this. Google is trading at 20 times earnings. It used to be 30. It's still got a ways to come down. Apple is trading at 35.5 times earnings. That's double what it should be. Should be in the teens. Broadcom, 79 times earnings. No way. Microsoft, 31 times earnings. Double what it should be. Let's go at Netflix, 49 times earnings. Triple what it should be. This is a $320 stock. It's at 972. Facebook at 593 is trading at 24.8 times earnings. Really overpriced by about 40%. Just 250 too high. That is what is the reality historically. We've got interesting times going on here. Amazon at 197 is trading at 35.5 times earnings, at least double its price. It's 50%, double too high. It's too high. Let's see, what else have we got going on here? How's Cisco doing? Cisco is 27 times earnings. Should be about $45. Let's see, what else we got here? Who else? I'm looking at big market cap companies. Pfizer 17.69. That's actually reasonable. Pfizer at $24.90 a share, not badly priced. What else? IBM is trading at 38 times earnings, double what it should be. It's 246, 247. 125. Let's see, what else? HPQ is trading at 10 times earnings. It's actually underpriced. HPQ should be more like 33, 35, interestingly. Home Depot at 358, trading at 24 times earnings. That has come down a ways because their earnings have grown, but I don't know if their earnings are that reliable going forward. They might need a haircut by about 40% on that stock because their earnings won't match the current PE multiple. It's not happening. I don't think so. Now with tariffs coming, no way. All right. Goldman Sachs trading at $5.49 a share, 13.5 times earnings, fairly priced in that neighborhood. Boeing, oh, what a mess. Not making money yet, $175 a share. They got a long way to go to justify this price. Target at $102.91, 11.6 times earnings. That's reasonably, very reasonably priced. JP Morgan at $245 a share, up 12 times earnings, not outpriced there. Walmart at $85 a share, 35 times earnings. It should be $40 to $45 a share. It's overpriced by 100%. Disney at $99 a share, 30 times earnings. It's been a rough number of years. I don't think they're through it. They're through it at all. If travel to the U.S. is in a slump from foreigners, Disney will pay dearly for that. It will cost them dearly. American Airlines trading at $10.95 a share, trading at 8.8 times earnings, heavily in debt. We've got to keep that in mind. So this price may not be that outrageous. I don't know, kids. Royal Caribbean trading up 19 times earnings. Again, if tourism backs off in America, that means every Royal Caribbean ship will lose 5 to 10% capacity across the board for the next 2 years. That is going to affect them on the bottom line because the first 5-10% of capacity that drops on Royal Caribbean is all their profits. It costs them so much money to run their ships. The first 80% of capacity just breaks them even. Beyond that, they start making money. You lose a quarter of that gain, that 80 to 100% capacity, 80 to 105% capacity. You lose 5-10% of that, you've just lost half your profits. This stock at 210 is overpriced. In my humble opinion, Robinhood trading at 41.55 today, 26 times earnings. Maybe a bit rich here. But again, they have other issues, legals that are hanging over their heads that will be around for another 5 years at least. It's a mess. We're down 360 on the Dow. The indexes are trading at high levels, and earnings will not be sustainable. That is the issue. Lululemon said it this morning. They indicated that their outlook going forward to try to reduce inventories and reduce their cost. They've got tariff problems. Lululemon makes everything overseas, everything. And they try to mark it up 90% to the American consumer. The American consumer does not have the disposable income available to spend lavishly at Lululemon. Only the top 10% can do it. The 90% below are broke, and they are not going to be able to easily go to Lululemon. They're going to go to secondary retailers. It's already evident.
They have that same problem in Canada because they make nothing in North America.
They make nothing in North America. They make nothing in Canada. They make nothing in America. They're simply importers of merchandise under license from overseas. Same problem that Apple has. Apple produces product overseas. They bring it into the United States, into Canada, and they're trying to avoid tariffs. Welcome to the party, pal. Get in line. Everyone's trying to avoid tariffs. I worry about stocks being overpriced for current earnings estimates and downgrades of earnings estimates. And that's the next wave of carnage you're going to see. Companies are going to come out aggressively and say, oh, we're cutting down overheads. We're going to reduce overheads. We're going to close underperforming locations in the retail level. We're going to reduce our staffs. We're going to reduce our overheads, and we're going to increase our share buybacks. They're going to talk the talk, but not walk the walk. They don't want to use cash to buy stock they know is overpriced. So they'll give you the illusion that they're going to buy back their stock by announcing major stock buyback programs, but they won't execute them because they're not obligated to execute stock buyback programs. Amazon has had for a decade a stock buyback program that they keep re-announcing all the time. They've never bought their stock back. Apple has, but not Amazon. This is the game that is played, and you are not maybe aware of it. It's the shenanigans that the SEC allows these public companies to do without any penalty whatsoever. You can announce a $5 billion stock buyback and not buy a single share back. The stock goes up in value because people are excited. Oh, the company's going to buy its stock back. It's way too low right now. And the company doesn't do a damn thing. Just the announcement makes the market go higher, and they don't buy any of their stock back. It's a game that is played all the time.